We all saw what happened with year-end S&P 500 price targets and how they ended up materializing in reality. Virtually every single major bank was some 10 to 20% off of where 2023 actually finished. So in today's 2024 video, we're going to take a lesson here and not make a year-end price target. This was something Mike Wilson, the 2022 Analyst of the Year award recipient, said was something that should not be done, picking some arbitrary date and setting some sort of price target. However, that does not mean that we're not going to analyze the market. We're just going to view stuff as being more on an edge of the cliff point of view, not necessarily implying that the market is on some physical edge of the cliff where it's going to plummet, although we're not saying that there's absolutely no parallels with that possibility, but that we are at this point here in time today, and what's ahead of us is one, unknown, but two, potentially dramatic in either direction, okay? Just that there is stuff ahead of us, and we're not going to, say it's a price target in X period of time. I think we should all get away from that. I've certainly learned that it's, trying to guess and, what the S&P 500 is going to do is not the best idea. And we're going to talk about more of that throughout this video. This is going to be hopefully a very good video. So let's just get right into it. While it might be tempting to rely on what's been happening lately to conclude that a soft landing has occurred and that there will be no hard landing, that seems to be almost like a suffocating consensus right now, that you basically have to accept that premise to have a respected voice, it seems, at this point. It's either you accept that premise or you're seen as defeated. At least that's how I think it is right now, that you are forced into accepting the soft landing premise. However, it is both historically and statistically too early to declare that victory, as not enough time has passed since the last Fed rate hike to the minimal time a recession starts over the last several decades. And we just so happen to have the most hikes out of all that time. Now, what does that mean? What that means is it takes somewhere between 9 to 18 months for a recession to begin materializing after the Fed's last rate hike. And we are not at that point. We're at some roughly 6 months. So we're getting close to the minimum point that we've seen over the last several decades. But we are by no means even at the, we're not even at the minimum for the recession to start. And we're not even at the midpoint, which is, when you can kind of start saying, okay, things are starting to wrap up here in this window, unless we're starting to see signs of slowdown, which we certainly expect to pick up, and we're not going to be surprised if that occurs. And honestly, I think there are very clear signs that this has been happening for several months. We've discussed many of them on this channel. I believe there's a pinned video on the YouTube channel that discusses many of these things. So, there's almost like a formulaic thing that I'm seeing, this because it's coming out of Bridgewater, that is a very good, in my opinion, and seemingly in the largest hedge fund in the world's opinion, that correctly sidestepped the great financial crisis, had a very interesting and public put option going into COVID in 2020. Now this is what they're saying. This, I think, makes a lot of logical sense. So a lot of people are confused, and understandably so, by the GDP growth numbers we are getting. And I'm not saying those numbers are fake, but we're going to get into corporate earnings later and corporate earnings growth later. A lot of the strength in the economy may be attributed to the aggressive financial and fiscal stimulus that the Federal Reserve and the federal government put into the economy, into the marketplace, and the effects that has had, seemingly overcoming the actual decline in net real wages. That is what has occurred. Net real wages have declined, yet somehow consumption has gone up and GDP has gone up. One factor that we're going to discuss is the fiscal stimulus. Now, how do we prove that point? Well, the whole world kind of went through the same thing at the same time. They went through this massive COVID shock. COVID affected every economy, and every area of the world seem to react differently to it. For example, Asia did very little stimulus to their economy. They kind of just, went more Hayek style economic stuff. And they didn't experience inflation at the levels we experienced inflation, but they also entered a recession earlier than we may possibly enter a recession. So that is one point, but it could just be one point. There's actually a second point that's in the middle. Europe did stimulus, economic stimulus, printing of money. They had inflation. They actually had more inflation than we did, but they're also not energy dependent at all, virtually. But they still did less fiscal stimulus than we did. Their economies seemingly entered a slowdown, a recessionary period. Look at Germany. This is a serious country. Sooner than we may, but later than the Asian countries. So it seems like on these two rough, extremely rough, and I'm not saying certain either, data points, that the variable of importance here seems to be how much economic stimulus did you do? That seems to have some impact on inflation. It also seems to have some impact on recession or not recession. This is very classic textbook economic cycle stuff. When you see inflation, when you see growth very hot, the Fed increases interest rates, they cause the economy to slow down. The textbook says that stuff is a recession, but we don't necessarily always believe in textbooks. So I have a script here. I'm obviously not following the script. I almost never use notes, although I've started to use them more so in recent videos. I now have a script, so I'm trying to find exactly where I should pick up. Finally, the United States has engaged in the most economic stimulus, and its economy remained largely resilient on the surface of it. However, there are many signs of cracks. If you remember the May Costco earnings call, they talked about how consumers, particularly on the low end, a lot of lower middle class people go to Costco. I would not at all judge anyone for going there, and definitely not if they are a wealthy person who wants to stay wealthy. However, they noted back in May that consumers were beginning to trade down from more expensive meats, beef for example, to lower cost meats like poultry and pork, and that they said this was consistent with previous recessions. I wish I had a big ass list of all the possible cracks I've seen. That I think is a very important one. So there are signs of cracks. Now, finally, when it comes to stocks, I don't want to say where I think the S&P 500 is going to go. I'm done with that game. I tried that game. Our fund was up 120%, doing some of that, not all of that. Don't forget, we were very bullish oil 2021. All of 2021, it was a rough year. 2022, phenomenal year. That's why we were up 120% in 1 year, in a very difficult year, in one of the more terrible years on record for the S&P 500, and one of the worst starts in history, if not the worst start in history, or second worst start in history. We were up 120% in that year. Yes, we were doing some shorting. Yes, we were doing some SPY shorting. But this year, that obviously kind of blew up in our face a bit, and we did not have a good year this year. That's just the truth of the situation. I will begin posting performance results once I am once again proud of them, which I'm not yet, but we will be. Anyways, stocks have obviously had a tremendous run. The S&P 500, what is it, 20-something percent? I don't know. I honestly don't care because I don't care what the index is doing. All I'm trying to say is I looked at that number and I looked at the earnings growth number, and they don't really match that well. And then I look at the projections for next year, and I go over everything I've said today. Essentially, that I'm not ready to declare victory on the soft landing. We aren't even at the minimum time it takes to get to a recession. There seems to be a couple other cases where a recession begins to occur in various different scenarios with various different variables. I'm talking Asia and Europe, and maybe we will follow. Real net incomes are down, although that is starting to recover. We are off the lows. Maybe that can trend up or get above the flat line before it's too late. I don't know. I'm not optimistic on those market growth numbers. That's just the truth of it. I think the market is very much getting ahead of itself in terms of earnings growth for companies, and we are at, near record all-time high earnings multiples and cash flow yields outside of, 2008 earnings contraction and COVID earnings contraction. We're basically at all-time highs in both those regards. So do I view the risk reward as favorable? No, unless I was incredibly confident that the market was somehow wrong about the forward earnings multiple or the forward earnings projections, that somehow we were really going to experience this explosive growth. I'm not saying it's impossible. I'm not saying I'm right. All I'm saying is I'm just not confident about that. I'm just not confident about that. What I am confident in are individual companies at reasonable prices. So let's discuss a few of those. While much of the market, or some of the market actually probably not even much of the market, well, a handful of stocks have gone up. The closer tied to NVIDIA, the better. I'm not trying to say NVIDIA was a bad stock. I was shorted. Guess what? I covered minutes, if not seconds, after I saw that revenue number, and then actually, more importantly, the projected revenue, the number they had for the next quarter. I think that was, sometime it was May 24th, 2023. It was my birthday. NVIDIA reported earnings. I was short that stock. I was experiencing a lot of pain up until then. Got that quick shot, got out, learned some valuable lessons that day. That stock, I think, has brought animal spirits out to some extent. Now, this is esoteric talk, but this is, I'm trying to figure out what's going on here, because I'm not seeing things. Yes, it's not as bad as feared, but it's not necessarily good. I don't think we should be knocking on all-time highs in the S&P 500. That's just me. But that doesn't mean I'm not in. I am not short any stocks. I have a very small put hedge. I'm otherwise long all the way. What am I long? I'm long oil and gas companies at extremely low multiples. Mostly oil companies. Some of them do a little gas. One of our biggest positions, for our largest position for a lot of last year, was up much more than the S&P 500. Petro Brazil, stock did very well. Dividends did very well. Price of oil always has been, always will be volatile. In my opinion, that is very much factored into the earnings multiples. And I think we're going to be having reasonable earnings from these companies for many, many years to come. If you remember Charlie Munger, he has in recent history said we shouldn't even be drilling our own oil. We should be buying it from the Saudis for as long as they're willing to sell it to us. And we should just keep our oil in the ground, because so many products actually use this stuff, and it's going to take a very long time to just replace cars. Gasoline is about 27% of total oil consumption. So there you have it. Obviously, diesel is some other percent. I don't remember exactly, but it's going to... Elon Musk said on the Joe Rogan podcast, it takes 20 years just to replace the, average length of a vehicle or something. So it doesn't require a whole lot of math. Then you add in the buybacks and the dividends. It's just a very good situation. I'm also not afraid of tech. I'm willing to buy tech stocks, but I'm not willing to buy the tech stocks, unfortunately, at these prices. Sorry, I need some water. I'm going to get some water soon. If you've been watching this channel, if you know who I am, if we've talked stocks before, you know I've been very bullish CRISPR since 2017 when I made my first purchase of CRISPR Therapeutics. And they obviously recently had the FDA approval. I added to those positions. They were smaller positions than I liked going into it, but that's because I'm just concerned about the market overall, and I'm worried about a broader pullback. I'm not trying to find it. I'm not trying to price it in. All I'm saying is I'm sensing things I don't want to sense, and I'm not. What's the word? What does Jamie Dimon say? It starts with a C. I'm not so compelled to buy a lot of stocks here, or to necessarily take risk on, given my inability to accept with absolute certainty that a soft landing has occurred, or even a moderate degree of certainty. I actually think the economy is going to continue to slow. Does it tip into recession? I don't know, but it's like I tried to use that edge of the cliff analogy. I don't know what's ahead of us. I don't know. So I'm not so confident. I'm sticking with what I am confident in. That is individual growth stocks that are, for whatever reason, reasonably cheap. I'm sure you can find other ones that you do due diligence on in the ARK-esque basket. You can probably, if you have a long time horizon, 5-year time horizon, deploy some capital there. I think the same is appropriate for oil companies, and so does Warren Buffett. Warren Buffett is a net seller of stocks as of late, but a net buyer of oil stocks. So that's today's video. Happy New Year. Welcome us all to 2024. I hope it's a good year for all of us and for the world and society as a whole, and we continue to advance in all regards. So that's today's video, and until next time, peace out.